You are a DIY investor, you might be brand new to investing, or you might be a more experienced investor just looking to take care of things yourself. You're here to learn. Let's get right down to it. Right now, the markets are at all-time highs. And the question right now is, are they going to keep going or is there going to be a correction? My answer to that is it shouldn't really matter. Today, I'm going to review 5 of the most important things that you need to know to increase the odds of having a successful investing journey, regardless of what the market conditions are. Plus, what I'm going to do is I'm going to look at some of the common criticisms of these strategies. I'm going to explain why the strategies are still valid, at least in my opinion. So let's jump right in here. I want to start with one of the things you're going to hear over and over, diversification. And this is all about spreading your investments across various asset classes, various sectors, geographical reasons. Why do you do this? Well, the obvious reason here is because it reduces risk. If one of the investments you have underperforms, the other investments that you have can offset those losses. The proverbial thing we hear, don't put all your eggs in one basket. This is essentially what that is. Today's markets, they give us actually the perfect example of how this works. If you take a close look at the markets today, a high percentage of gains have come from just a handful of stocks, or very few eggs if you use our analogy, mostly from one sector. The S&P 500 is up around 46.5%, but that Magnificent Seven, you keep hearing about it. Apple up 77%, Microsoft almost 93%, Tesla has doubled, Google has doubled, Amazon up over 129%, Meta 330%, and Nvidia, the big leader here, at about 750%. Those are the big 7 stocks that have led this the strong markets that we've seen recently. Now, the critics of diversification are going to say, see, if you own a bunch of underperforming stocks, why don't you just focus on the hottest sectors? That's where you're going to make your money. Managing a portfolio, and this is the critical part of this discussion here, isn't just about picking the hottest stocks of the day. That's great if you happen to luck out there, but it's not how you actually manage an investment portfolio. I want you to imagine for a moment, instead of being an investor, you're actually a shipping magnate. And you have a fleet of ships that you're navigating across the ocean. Now, if you rely solely on 1 or 2 or even a handful of ships to carry all your cargo, which you place a high value on, the risk of something bad happening is high. There could be a storm, there could be mechanical failure that could sink those ships, and that would cause you obviously a significant loss. Now, on the other hand, if you take your cargo and you distribute that across a fleet of different ships, the chances of losing everything goes down, even if 1 or 2 of those ships run into trouble. In exactly the same way, an investment portfolio that's concentrated only in a few stocks is vulnerable, obviously, to any unexpected thing, market swings, market crashes, but a diversified portfolio will spread the risk across the various investments. That increases the overall chance of success. Now, that's a key differentiator here. If you have a handful of stocks, they can do extremely well, they can do extremely poorly. But if you have a longer term perspective and you want to increase the chance of success, this is a good way to help improve the odds that that's going to happen. So to diversify, what do? Well, you have a mixture of things like stocks, bonds, real estate, commodities. You include both domestic and international investments. I'm speaking to you as a fellow Canadian here. You don't want to have all your investments in Canada. Really importantly here, you need to spread those investments across different sectors like tech, healthcare, finance, resources. You'll see a whole bunch of different things out there. There's 11 main sectors in the Canadian and US markets. You need to have a look at your portfolio to make sure that you have exposure to more than 1 or just 2 of them. Not necessarily all, but more than 1. And today, a lot of portfolios are very, very concentrated. So what do you do here? First of all, you need to know what those various slices of your pie look like. You need to know, if you are actually over-concentrated in any area. And a lot of people have no idea if that's the case or not. I want to take a look here at my profile under the Blossom Social app, and you can see this is the breakdown of different sectors that I have my assets in currently. Financials is the biggest one, technology 18%. You'll see energy at about 18%, consumer staples, and so on down the line. You also want to step back and take a broader look at the actual holdings you have. You can see here the largest individual security I own is Microsoft at 6.2% of my portfolio. Apple 5.8%, Amazon, and you can see on down the line here. That is where I'm positioned today. If the worst case scenario happened and Microsoft went out of business, my portfolio would lose 6% or so of the value. Now, some people will argue against diversification. Here's some of the main reasons that they give. Number 1, People will say that diversification dilutes potential gains, and they'll argue that if you spread your money too thin, you might miss out on the big returns from a single well-performing investment. And that's kind of what we've just talked about here. The current example, of course, is NVIDIA. And if you had only a small piece of your money in NVIDIA, you'd have missed out on the big run that it's had. Now, you could argue, some people will argue, that if we knew then what we know now, you should have backed up the truck and loaded up. Even on a bit broader scale, if you look at the Magnificent Seven, the same strategy applies there. Why don't you own those while they're doing well? And I would push back a little bit. I'd say it is true that diversifications can limit the maximum gains. It can top you out from a single investment. That's if you are over diversified, but it also protects you, importantly here, from significant losses. The short term, as we know, is very, very unpredictable. The example I give you is Tesla. If you look at this chart here over the last 5 years or so, the company has done very well. Those of you who had a large portion of your investments in Tesla will have done well. And I know there are a lot of people actually who are kind of overweighted in one or two or three of these stocks. But of course, these gains came with a lot of volatility. If you look here at early 2020, the drawdown from the peak was 50%. Now, a lot of the market was down in 2020, of course. The S&P 500 was down about 33%. But if you look at early 2023, from its peak to its trough, Tesla was down about 73%. Now, a lot of the detractors from diversification will say, yeah, but if you just held it, look how much money you made. True, but a lot of investors can't stomach that much of volatility. They'd end up bailing on the stock and end up losing money. In most cases, over time, a well-diversified portfolio will tend to provide a more stable and consistent returns, and that is the key to long-term growth. Now, there is a second criticism that you hear against diversification, and it's that you're overcomplicating things. That is an argument that some people believe that it complicates your portfolio, makes it harder to manage, harder to track performance. Again, I'm going to push back on that, and I'm going to say that managing a diversified portfolio is tougher. It's certainly not for everyone. In fact, maybe for a lot of people, it's not the right solution. The process can be simplified if you use ETFs, for example. Inherently there, you're getting that diversification. So you don't have to manage a big portfolio, but you can get that diversification through the use of a fund of some nature. Plus, with that, you get the peace of mind that the reduced risk outweighs the complexity of it. So I'll sort of summarize that by saying diversifying doesn't have to mean complicated. Now, the second thing that you need to know if you're going to be a DIY investor is your risk tolerance. There are two types of risk tolerance that you need to assess. First of all is your willingness to bear risk. This is referred to as your risk preference, and it speaks more towards your attitude toward risk. It generally reflects your personality, your investing experience. Now, once you know that, you then have to assess your ability to take on risk. This is your risk capacity. This is mainly determined by your goals, your personal financial situations there. Many factors, including your age, your employment, the number of dependents you have, your responsibilities, those all impact that ability that you have to bear risk. It doesn't matter if you really want to take on more risk, you probably shouldn't if you have those obligations. Now, the biggest influence is your personal financial situation. What is your investment horizon? What are your emotional responses to market changes, whether they're down or up? Now, what should you do here? I would say assess your financial situation, consider how long you plan to invest, reflect on how you've reacted to past market downturns. This will help you stay calm during volatile periods. But again, there will be some counterpoints to this. The number one criticism I hear is that your risk tolerance changes over time. And this is true. Your tolerance does change. Some would argue that your financial situation, your emotional state will fluctuate, and that makes it difficult to maintain a consistent strategy. Although I do agree somewhat with this, the whole point is understanding your risk today. Who are you as an investor today? Importantly here, you want to assess this at a time when you have a calm mind, not when your emotions are running high. If the markets have crashed, if the markets have spiked, these aren't the times that you should be assessing your risk tolerance. Also, risk tolerance isn't just about the markets. It's inherent in your personality. That does evolve as time goes by, but it's really baked into who you are. And when I was working as an advisor, I worked with senior clients who had a high tolerance for risk. I worked with younger clients who had a low tolerance for risk. So it doesn't necessarily go with age. Again, it's true, risk does evolve, but that typically happens very gradually. It doesn't happen overnight. Now, periodically, you need to reassess your risk tolerance, adjust your portfolio as needed, and that will ensure that your investment strategy remains aligned with your current circumstances and your goal. When I was a single guy, my willingness and my ability to take on risk was pretty high then. I got married. I had a couple of children. At that point, my capacity to take on risk went down at this point. That may be a situation you find yourself in. Also, another criticism you're going to hear is it limits the growth potential. And this kind of goes back similar to the first topic we talked about here. Some people will say that if you focus too much on risk tolerance, that can limit your growth potential, especially if you tend to become overly conservative. The rebuttal I have to this is that balancing risk and growth potential is the key. Again, if you understand your risk tolerance, you can find a mix. It still offers growth, but it keeps your stress level manageable, and that will help, importantly here, that you stay invested for the long term. Even if you lean more towards being conservative, that's who you are. If that's your personality, it still beats on taking too much volatility, having a bad experience, and quitting. And again, I've seen that happen too. There are a lot of people out there who are too scared to invest because of bad experiences. In cases like this, I've seen people who will only buy GICs or only buy term deposits if they fall under those insured levels. They wouldn't even venture into low risk assets. And this hurts them at the end of the day. Even low risk investments are better than none. Now, the third category here, research and due diligence. Before you invest, it's crucial that you do your homework. It's crucial that you know how to do your homework. And this is especially if you're doing things yourself. Some of the top things you need to learn are, you need to learn some of the key ratios and how they work. As an example here, I'm just going to look at the price to earnings ratio. And this is not just one thing. You hear about the PE ratios thrown around like it's one thing. It's not. For example, is the number that you're looking at a trailing PE or a forward PE? That will make the difference. The key is, how do you take this number and then use it to assess an investment opportunity? For example, how does it compare to previous time periods against itself or against the sector? So those are all things that you need to learn. You need to understand market trends. Is the industry that you're looking at investing in, is it growing? Is it dying? What stage of the economic cycle is it in? Most of us will remember people piling into pot stocks when they were their rage a few years ago without ever sufficiently assessing what in fact they were buying. That's dangerous. The key here is that you have to establish a system, a workflow that works for you. There isn't just one way to do it. There are many different things. Finally, on this topic, you have to find a way to stay informed about industry news, economic indicators. If you do those things, you are going to be better equipped to choose solid investments. Question obviously is, where do you go? Well, there are tons of sources out there. There's financial news. You can look at our channel on a broad sense. We look at things on an ongoing basis, things like interest rates, employment rates, giving you some idea of where the economy might be going. We cover the key news stories of the week. There might be something that comes out with a company that you're invested in or you want to invest in. You can get a better sense there. Also, a platform I use a lot is Seeking Alpha. This is a place where you can go and see varying opinions. I look at it for if I'm looking at doing something, what are the downsides to this? You get a sense of sort of the pros and the cons, the risks and the opportunities there. And also, I looked at it earlier at my portfolio, Blossom Social, see what other people are thinking, see what other people are invested on. You're not going to necessarily go in and just copy them, but it will give you a sense of what's going on out there. The main point here is you need to find something that resonates with you and use it. Of course, not everybody's going to see it the same way I do. There's a lot of criticism here. One of the biggest ones is you run the risk of information overload. Now, you talk about due diligence. Most people would agree you should do that. And people will say, well, yeah, but you're going to get information overload, and that will lead to a paralysis by analysis. There's so much information available out there today. There's a lot of advice that would just say, don't worry about it. Just buy the S&P 500, buy an ETF, and let it go from there. Now, I would say that is a valid concern. But if you have your system, if you have your sources, this doesn't have to be brain surgery. If you have a process, if you focus on key indicators, if you use reliable sources, and importantly, if you streamline your research, you can get it done. It's not about the quantity of work, it's about the quality of work you can do. Another criticism you're going to hear, there's no guarantees. No matter how much research you do, there's no guarantee of success. Some people would even say that due diligence makes it sounds more valuable than it really is. Research, of course, doesn't guarantee success. Nobody's saying that, but it does at least significantly increase your chances of making good investment decisions. It helps you understand potential risks, rewards, which is certainly better than just investing blindly. A key here, avoid big mistakes. If you always look at not only the upside, as I mentioned, you look at the downside too, that will help you avoid any of the big mistakes out there. You can't just take a guess when you're investing. You need to at least have a thesis at a minimum. Fourth thing I want to look at here, costs and fees. Now, investing isn't free. There are brokerage fees, there's management fees, there's transaction costs, and these can eat into your returns over time. The key here, if you know these costs, you can help choose some more cost-effective investments that can help you maximize your net returns. You can, for example, invest in ETFs. If I use VFV as an example, look at the fact sheet, look at the ETF facts, look at the prospectus. If you're trying to find the information, you can find it. Yes, it will take some work in some cases, but it is out there for you to find, so don't just gloss over fees. Also, where possible, opt for lower cost options to keep more of that money working for you. You look at the management expense ratio, it can be very low. Now, it also can be higher, and this is something to keep in perspective. It can be higher for specialty funds. And again, the question here is there value to you? An example is, very popular these days are covered call ETFs. And personally, I have 2 covered call ETFs in my portfolio. For me, it's worth the extra fee to have someone else manage that for you. Over the years, I've managed my own covered call portfolio, my own covered call programs, and it's a lot of work. So at this point, I just farm that off to someone else, and I'm happy to pay that additional fee for the extra benefit that I get from there. Now, if you work with an advisor, make sure you're getting good value. Bottom line, are you further ahead than you would be by paying this fee to the advisor than you would if you weren't? That's really important that you do that. Another thing you can do, subscribe to paid services, but you have to monitor them from time to time. If you subbed for a Seeking Alpha or something 2 years ago and you find you never go there anymore, well then cancel that. Last thing I want to talk about, one of the most important things is long-term perspective. And I agree that investing with a long-term perspective means focusing on your financial goals and holding your investment, in most cases for years and years or decades and decades. When you do this, you benefit from compounding returns. It reduces the stress of market timing. It helps you stay on course during market volatility if you do in fact have that long-term perspective. For the most part, this is my approach. It has been for the longest time. In fact, we believe so much in this. If you look at our Investing Academy, the very first lesson in the beginner's course is the oak tree analogy that Brandon gives, talking about how you have to have a long-term perspective to build wealth. So yeah, we believe in principle that having a long-term outlook is a great strategy. Some of the keys here. You have to set clear financial goals like retirement or buying a home. What are the things that matter most importantly to you? Then the difficult part, you have to stick to your plan. You have to avoid frequent changes that are based on what's happening in the market today. These short-term market movements, you have to be disciplined. You can't let them affect you. Also, you need to review your portfolio periodically to ensure that it still aligns with your objectives. It's easy to get off course if you don't stay disciplined, stay diligent to make sure that you're still on that same path. As always, there are people who will disagree with this. And the number one criticism I hear about long-term investing is that you have missed opportunities. And some will say that a long-term perspective can lead to missed opportunities from the short-term gains that we can see. And particularly, you're going to see this in a rapidly changing market like we've seen recently. Now, I would say in rebuttal to this, short-term gains can be attractive, but as I mentioned earlier, they come with higher risk. And for not for everyone, in fact, for a lot of people, maybe most people, that sort of the up and downs of the markets, if it's too risky, if it's too volatile, might turn people off of investing in the first place. So what a long-term strategy does here, you benefit from compounding. It generally leads to more reliable wealth accumulation. With good companies, you're going to get your fair share of great years. Example here is Microsoft, and you saw earlier it's one of my top holdings. Most people say that Microsoft is a good long-term chart. But it's been around since 1975. And if you look at this chart here, these are one-year returns that go back to 1987. You can see here there were a lot of what I would call good years, a couple of years with 120% plus gains, and even more with 50% calendar year gains. This is a good company that still showed some really good gains from time to time. So it's not like if you go with a more solid company, you're not going to get those, you still would. Importantly, it's not a binary choice. So what I do here is I advocate for having a long-term strategy, but with a carve out if you need for some shorter term plays. It can be both if you have the time and knowledge to manage that portfolio. The key here again is balance. And just like the occasional treat wouldn't disrupt your overall health benefits of a balanced diet, short-term investments shouldn't overshadow the primary focus of long-term growth and stability. And that's it. 5 of the most important things that you're going to need to know as a DIY investor. Thanks for watching. We'll see you in the next video.